Good morning, good afternoon, everyone. Thank you for taking the time to join our November edition of ARIVE Partner Spotlight. For those joining first time, ARIVE Partner Spotlight is a monthly webinar series that we host where we invite experts in mortgage industry to talk about topics which are relevant in today's market. My name is Harish Tejwani. Along with my colleague, Amy Hulett, we'll be moderating today's webinar. And I'm very excited to have two phenomenal partners join us today. First is a wholesale lender that partnered with us earlier this year. They have the unique distinction of being the first lender that went live in 2024. Click and Close. So I want to thank the panelists for taking time from their valuable, busy schedule to join us today. We also have one of our very early partners of ARIVE. So a big shout out to Andy Price from Price Mortgage. Thank you again, Andy, for taking time to join us today. Today, we are going to cover an extremely important topic, which we believe is very relevant for home buying to be successful. Down payment happens to be the biggest challenge why, as we learn, consumers cannot get into homes today. So we're going to talk about down payment assistance program. So Click and Close specializes in offering unique such programs due to their partnership with a nonprofit. They're able to offer this nationwide. They have options for forgivable versus repayable. As we will find out many interesting features about these programs, like there are no income limitations. You can actually use this on manufactured homes. There is a whole lot more that I believe our colleagues from Click and Close will share. So without further ado, I'm going to hand it over to Kerry from Click and Close. So do you want to introduce yourself,
your sure.
colleague, and this is an interactive session. So if anyone has any questions, feel free to use the Q&A tab below. We'll be monitoring as they come.
Absolutely. Appreciate it. I'm Kerry Webb. I'm the Executive Managing Director with Click and Close. And John Eldridge is with us as well. John's our Regional Sales Manager based out of Charlotte. I'm out of Nashville. And so anyway, I just want to thank ARIVE for actually, I think it's a brilliant idea to set up this platform. It helps us to connect with our brokers, and at the end of the day, helps you guys close more deals. So hopefully you'll learn a few things about us, a few niches that'll help you out. So we've been around since the 1940s. Obviously, Click and Close is a relatively newer name. Back in January of 2022, our fearless leader, Jeff Bodie, decided to sell his retail organization and for us to focus only on wholesale and correspondent. And that's what we've been doing ever since. We've had wholesale and correspondent for many years, but decided to focus on that, and kind of the rest is history there. I'll keep this kind of brief and let John work into the more of the details of the products and the SmartBuy suite. But I will say, obviously, we're Fannie, Freddie, Ginnie, seller, servicer, and issuer. We service about $8 billion worth of loans. That's not a big number, but we always sell when the market dictates that. One thing that we are a little bit different in is that we have our own in-house servicing. So we typically don't use a sub-servicer. So, no offense to the Ocwins of the world, the Loan Cares, the Mr. Coopers, but they are really great at servicing conventional borrowers who make their payments on time. We do a lot of government business, a little more high touch, and I think having that servicing department inside that's more familiar with the Ginnie Mae, Loss Smith, waterfall process really helps us out as an organization. So I'll be brief. We have done a little bit over $3 billion worth of down payment assistance. So we provided that much. We think that's a big number. We're looking to grow it. But I'm going to briefly go over 4 products. John today is about the SmartBuy suite of DPA. John will go into detail on that stuff. But I'm going to mention 3 other products as well that I think will help separate you guys from your competition and be able to speak to your realtors and referral partners. Obviously, the first one is the DPA, what we call a SmartBuy. More specifically, our hottest product right now is our SAM product, which stands for shared appreciation. John will go into detail. You guys will understand it. It gets a little confusing, but we're here to answer any questions that you have, go over the product in detail, and I think it's something everyone will be able to promote. Another product that we have that most don't is our one-time close government construction loans. So we do one-time close, government construction. We do FHA, USDA, and VA on that. So you guys can reach out to myself or John after the webinar, send us an email, call us. We can answer any of these questions about these products that we have. The third one is e-notes. So if you're non-delegated on this call, you're doing conventional loans, there's no reason you shouldn't have an e-vault set up. We can help you guys set that up, and how it's going to benefit you is you're going to save money, and you're going to save money two ways. Number one is the dwell time, obviously with your warehouse banks. All your warehouse banks are what we call repo lines. So part of their covenants is they have to take ownership of that note. So when you have an e-note, when you close on an e-note, it happens immediately the same day. So when they receive it on your e-vault, and the e-vault that we share with your warehouse bank, they've obtained ownership. So that means we can buy it. So typically we buy our conventional e-notes the same day or the next day. So you're dramatically cutting your dwell time on your warehouse bank, which saves you interest. And then the next is, how many of you guys have lost a note shipping it? We all have. You got to ship the notes, you got to ship the lunch, you got to ship the Bailey letter. None of that has to be done anymore if you use e-notes to close your conventional loans. So get with us on that. That'll definitely save you about approximately $200 on your conventional loans. So if you're doing non-del, conventional, $200, extrapolate that against your production, that adds up, especially when there's margin compression that we see just about every year in this industry. The last thing I want to go over, a little niche, is our attorney opinion letter. So if you're a broker working with builders, there's no reason why you shouldn't try to take advantage of our attorney opinion letter, which means you can save money on, I won't say unwarranted, but if it's a builder, they develop the land, do bars really need to pay for title insurance? My answer is no, I don't think they do. They're pretty safe. We'll leave that up to you guys. You can use your own attorneys. You don't have to use ours, but that's another way, especially in some of the more, states where title insurance is more costly. It's a great way to save your borrower a couple $1,000s. So that's all I have today. I'll be around. I'll jump in, answer any questions as we go, but I'm going to hand it over to John here.
Hello.
John, you can hear us?
Oh, yeah, I can hear you. So, hey guys, my name is John Eldridge, also with Click and Close. So I'm here to talk about our SmartBuy product suite, which is our down payment assistance programs. We're going to go over some, housing obstacles and buyer skepticism, reasons to think about, down payment assistance loans, go through what our SmartBuy overview looks like, and do some comparisons. Also have Andy Price is on the call at Price Mortgage to share some real life conversations about utilizing our program. And we're known as the GO.A.T. DPA is our nickname of our product, and I call Andy the GO.A.T. father. So he's the one that coined the word the GO.A.T. DPA. So we're going to talk about that here in a little bit. So obviously, our goal and why we love doing down payment assistance loans is to help borrowers get into homes, become homeowners, right? So us trying to find multiple ways that we can allow a customer to benefit from that, and you guys facilitate that with your borrower, is what we strive to do, and is what we're doing here with our down payment assistance loans. So as you can see here, as rates ticked up, what happened with home prices? Almost the same type of graph, right? The graph on your left shows what happened in the interest rate market when rates went low, and then rates have continued to climb back up the ladder. But if you notice the graph on the right, affordability has definitely not done that same level. So it's went up along with interest rates. So that's obviously added to the crisis of what we're dealing with. So here's some interesting statistics regarding borrowers' ability to save for down payment. So this was a survey that was done back in January of this year from Bankrate. And if you see on the left-hand side, the question was asked, how much time do you need to save for down payment? And the majority winner of that category was never. So 20% of the respondents said they'll never have enough time to save money for down payment. The next one said, 3 to 5 years was second option. And then if you look on the right-hand side, it's the reasons why. So number one answer is their income isn't high enough, or the cost of living is too high. So again, talk about what is the reasons why down payment assistance has become such a greater need in our market space. This is another example of reason why, because most of the borrowers say, hey, I don't have ability to save for the down payment funds. And the reasons behind it is because my income is enough to put enough money aside, or the cost of living is too high. So very interesting facts looking at that. All right. So here's just some statistics about your average cost of rent. Again, borrower studio, $1,500 to up to a 3-bedroom at $2,200 a month. So again, putting out, hey, look what it costs to rent versus how we can help people go from renters to buyers. And you're doing your wealth comparison between homeowners and renters. Again, owning a home is going to get your borrowers on the path to gaining wealth through equity in their home, and generally is deemed the largest investment or asset that person's going to have in their portfolio. So things we can do to help them become homeowners and get them on that track is what we're here to do. So you see on this, there's skepticism among borrowers who are qualified, because you're seeing there was 7.9 million families said they were income ready, but most of them are concerned about having the funds available, and what does it take to actually get into a home. So, and this is a greater population of prospective homeowners. And look, with only 44% believe ownership is within their reach for an average American. I mean, that's a pretty low number. So that's why us having access to down payment funds, finding ways to help make these people understand that there are paths available to them to get into a home that help them achieve that quote unquote American dream of becoming a homeowner. So that's what we're looking to do. So, but now we can look at to see some things that are in the marketplace and what we're trying to do about to help fix that. So again, revisiting our chart, looking at the average interest rates and where they were, how they've went down and how they've went back up. But historically, we're still not where rates were back, 15 years ago. But they're a lot higher than when they were, 3 years ago. So it's still causing problems where interest rates are now, and the affordability aspect we are talking about, and what's keeping people on the sidelines. So that's why we said, hey, let's think about reasons to rethink about doing a down payment assistance loan. So the first thing is down payment assistance loans helps address their challenges of providing the funds for down payment, right? Well, where's the money coming from? Well, now utilizing a down payment assistance program, we can help bridge that gap. 31% of loans, of FHA loans that were declined for insufficient funds could be salvaged because they had an option to go with a down payment assistance program. With us, the DPA program doesn't add an additional time to the loan origination process, because this is our loan product. We're the decision maker. We underwrite these loans in-house. Our underwriters look at these like a normal FHA loan. There's not an extra microscope put to it because it says DPA attached to it. And then ultimately, we service these loans. So we want to make as many of these loans as we can to provide opportunities for as many borrowers to be in a home. And then you see that last one was the percentage of down payment fund usage has tripled since 2010 from 5% to 15%. I would say that's probably going to be even greater in 2024. I've joked and said, hey, how many people call you on the phone as a broker, as a loan officer, and the first question you ask them is, how much money have you saved up to purchase a home? And they say, I got $2,000. So $2,000 really doesn't get them very far in today's world of where home prices are, to help them without providing some form of assistance. So we have partnered with our own nonprofit entity that we created to help facilitate our down payment assistance program, which we named the SmartBuy program. And SmartBuy allows us to do an FHA loan where we're doing an FHA first mortgage, and then we're providing the down payment assistance in the form of a second mortgage. We can also utilize our SmartBuy program for USDA loans. So even though USDA is already at 100%, we can utilize these funds to help cover their closing costs. So it is for FHA or USDA options. Again, it's available nationwide. We can do lender paid or borrower paid comp. The debt ratio is not restricted. We go off of AUS findings. No income restrictions, and we're not limited to being a first-time home buyer. So those generally the big things right up there on those bullet points. Again, not a first-time home buyer, don't have income limits. Your DTI goes to AUS approval, and the fact that you can have lender pay compensation, which is important to you guys on the broker population, because that's generally most of my DPA folks can't say yes to all four of those buckets at the same time on every loan. I would say we look like mad scientists when we're in here looking at ways we can utilize our down payment assistance program of trying to find other options available. And we'll go over our normal DP, as I call it, and then later on we'll talk about the shared appreciation option as well. So in a nutshell, here's our DPA program options. We have a forgivable and we have a repayable. The forgivable program, the second mortgage has no interest, no payments. If they keep the first mortgage for 5 years, the second goes away. The forgive program goes AUS approval, or we'll do a manual underwrite, and that goes down to a 620 credit score. The other option is our repay. Our repay takes the same second mortgage. This time we put it on a 30-year balloon, a 30-year term with a 10-year balloon, and that has a rate of 9.99. But the rate on that first mortgage would be lower when compared to the forgive. The repay does require a 660 score. But outside of the 2 credit score requirements, everything else is 100% FHA guidelines. So there is not pages or lots of things you guys have to memorize, concerned with about when you're trying to do a DPA loan as to, oh my gosh, what are the rules for me to do? And I like to say, if you've ever done an FHA loan before, you can do our down payment assistance program. When you're using ARIVE, you're literally putting in the down payment funds as a subordinate financing. Check the little box there for subordinate financing in ARIVE. Put the dollar amount in there. You put Click and Close as the lender. The source is your nonprofit community entity. And now your CLTV is at 100. So when you're running AUS, that's the only difference between running this and running a normal FHA transaction. Advantages of using our DPA program compared to a lot of your state bond programs. Again, we talked about no income limits. Most other state bond products have, income limits. Same thing, not required to be a first-time home buyer. A lot of those entities also require that. We have options to go to a 5% down payment. Some of those state bond programs don't allow it. We do offer permanent and 2-1 buy downs. Generally, none of the state bond programs are offering buy downs. It's whatever that rate is, and that's what the bar gets with. So the fact that we can do a permanent buy down just means going to lower on the rate stack, or actually doing a 2-1 buy down to get those that temporary lower interest rate for the borrower to qualify for. Our max purchase price is only limited to the FHA county loan limit that we happen to be in. So we will go from all the way up to what 1.1 million, whatever that is, in Orange County, California these days. So what your highest high balance FHA loan, we can still do a DPA assistance option for. Then down here at the bottom, just some various states that we were comparing our DPA to some of those state housing programs. And the common theme is most of these are first-time home buyers. Both of them have income limits. So with ours, we like to say you have the widest safety net of promoting your product to borrowers, because, hey, more people can fit when you don't have to restrict it to, well, only if you don't make X amount of dollars. Well, only if you're a first-time home buyer. Well, only if we have this. Well, you don't have to put a bunch of disclaimers about what you can offer your customer when you're speaking to your real estate partners about what opportunities you have available to them for down payment assistance loans.
All right, and I'll just add to your, John, what you said, and maybe Andy can supplement that. So when you are in ARIVE, you are running pricing scenarios, just pick the mortgage type as either FHA or USDA, put in the correct LTV and second lien payments, and then the system will find all these programs for you guys. And if you're approved with Click and Close, you'll see them on the approved list. If you're not approved, you'll still have access to them, and you can sign up with Click and Close right through one click from the ARIVE platform. So make sure you check out our marketplace product options if you're not approved with them. And if you're approved with them, obviously you'll see them. And John talked about how you can check a box when you're in the LOS to structure those loans.
So, I mean, just real quick, one thing for me, when I first heard about this, it was pretty new, and obviously I didn't want everyone to know about it, but here we are, you know.
I know, Andy, you called me to say, will everybody find about this? So that was a good conversation.
Cat's out of the bag. Now, it's been out of the bag for a while, but one thing I'll say about Click and Close is, a lot of times the DPA loans are really painful when you're trying to do them at certain places. And one thing I noticed right away is this is their wheelhouse. They know it, and they do a great job on them. It's as easy as doing a regular loan. John digs in. He'll go in there and help you with findings if it's not approved. Sometimes when you got these files with these DPAs, you can get some additional risk layers, and sometimes AUS can get a little finicky. So he knows a lot of different tricks and things that may help get a file through. But yeah, they knock them out, and the same with any loan. Like I've done conventional loans there. I've done all kinds of stuff with them. It's always a good experience. They always do a great job. But yeah, when this first came out, I'm like, this is the G.O.A.T DPA, and like I was telling them, really, I haven't seen any royalty checks yet. We're in talks, we'll figure that out. But yeah, it's a great program, because again, there's a lot of the hangups we have on a lot of them, as far as max amount, or being a first-time home buyer, income limits, and all that stuff. That stuff goes out the window. So you have a lot of people that can take advantage of it. And when I get in there and people are asking if there's assistance programs and things, especially, they'll talk about it later, but they'll even do manufactured homes on some of these. So and just being able to do a 2-1 buy down or a 1-year buy down on a DPA, I mean, that alone differentiates you and is a good thing, conversation starter with your database of realtors and your past clients, or ones that have been on the fence, or pre-quals that haven't done anything. All those things are super helpful. It gets you in front of people. It's a good way to talk about it. But I mean, if you want, I can share my screen and I can show you a file, like how I structure it, and then in ARIVE, and then show you like some pricing. This isn't going to be pretty because it's a 600 FICO, so there's some hits for that. 660, 640, those are going to look a lot better, of course. But if you'd like to, I could.
Yeah, go for it, Andy. Make sure it is dummy data, correct? It's not a real live file.
It is a live file, but
let's make that score like
you won't see anything other than a name. So
Andy, put a score up a little higher, because 600 is only going to get you the shared appreciation. So
yeah, I know. Well, let me try. Let me see if it'll. Let me do this. I'll do a 660. And I'll do. Sorry, Arrive's taking a minute to update. I need some extra bandwidth if you
Uh,
can, real quick. All
There are
right.
some great questions. Maybe we can take them, Andy, as you pull this up, and maybe John, you can answer. Is there any specific training required for loan officers? Many DPA programs requires loan officers to be trained. Anything you can talk about that?
There's nothing specifically. Basically, we can roll the product out with you guys individually, go through the nuances of the program. Like I said, other than the credit score requirement, that's the only nuance to FHA, and then showing you how to set it up in Arrive. So that's something we can do, at, 30 minutes or less, to go through that whole process. And the good news about training with us is this is not a one time only situation. It is not, hey, we show you once how to do things and don't call us again. We're very hands-on, and we expect, hey, anytime you have problems, go in there and help you guys figure out what's going on. So I've had to help Andy quite a few times, even though we've been doing business together for over 2 years now. So
Yeah, it happens, you get stuck on things, but sometimes they can have wiggle room on what program they use and things depending on the file. So, just always get with John and he'll make sure to do the best thing he can for the file. All right. Can everyone see my screen?
Yes.
Okay. So this is just 300,000. I did 660. So we'll see. But basically what you do is you click this subordinate lien button. One thing to note with Arrive, and maybe you guys can fix this at some point, if you put in a payment here, if there is a payment, it doesn't flow over to here. So you always, if you're doing repayable, you'll need to put in a payment on that, whatever that is. But otherwise, if you're doing non-pay, it's zero payment. But if there is a payment, you do it. Basically, it's a 30-year AM, 10 years, it's due, right? So you go into a calculator, because they don't have one here where we can plug it in, which would be nice. Another little pointer. We can plug in the second financing to generate a payment. That would be cool. But anyway, that's another story. But yeah, so put that in, make sure it flows over, to this section here. Your DTI will be off. But we'll do it like this. We have a subordinate lien, and to make it, the least amount confusing, when you go to product and pricing, only select click and close. And I'm just going to do borrower paid, just so it's easy to see. I'm buying out the underwriting fee, and I'll just put a target rate of 7.25, and we'll price this out and see what we get. All right. So the closing cost assistance one, that is not for down payment, that is for closing. So let's say they have their down payment, right? Then you can go in and you could use this to give them help with the closing costs. If that's still how you guys work that, I imagine.
yeah. Mhm.
Yeah, I haven't really done much of that, but that is an option. And then you have the repayable. So that's the one where you have a payment for the second mortgage. But you can see, one thing I like to look at is the rate stack on these, because like you'll see, like right here, look, 7.1's a lot higher. So say your comp plan's at 2, you're about 0.8 cost for that right there, and that's pretty good. But look, I mean, you can go down, if you got some money to play with, 6.625 gives a little back, and they'll have a $500 admin fee added to this too. But I mean, there's some great spread here. But yeah, if you look, like if you're just going for top rate, that's you can get 7.75 and 7.125 are damn near the same rate or same cost or credit. So make sure you're looking at your rate stacks, and for example, let's say you have somebody to play with. God, if you could charge them 2 points and you can get them a 6.625, that's not too far off from market, really, so that's a great option for them. And then you got the different ones. I'm not sure what the
SB is probably SmartBuy, if I'm correct.
That's the closing cost assist. So then you have the 3.5 or 5% repayable as well. So here's the 5%. It's going to be worse pricing because they're doing 5% instead of 3.5. But still, I mean, 7%, you still got a little credit left there. This is borrower paid, buying out the underwriting fee. Here's the forgivable. So the forgivable is where there is no payment on the second mortgage. So, I do a lot of the repayable. And the main reason I like the repayable is because, one, the rate's lower on the first, but I also like it better because they already have a payment on it. And then it's an easier conversation about when it's time to refi, right? Because they're not like, well, I'm going to wait 5 years for it to be like, no one's going to wait 5 years to have it forgiven. They're going to refinance when the rate's lower. But if they're already making a payment on that second, it's already assumed like this isn't going away, right? So it's a little bit, to me, it's a lower payment, more affordable. And it's like, yeah, we can get rid of the first and second payment, combine them in one on a refinance. One thing to note on the, if you're doing streamlines on these, you can't, because they will not resubordinate these liens on these ones. And then the other thing to note is to go off of current value for FHA, they have to own it a whole year. Otherwise you're stuck at purchase price. So some things to note, and those are conversations to have with your customers. Hey, you'll have this at least a year, but if you can couple this with a 1-year buy down or 2-year buy down, you know, they're going to be sitting pretty good for a while, and they'll have a lot less money to bring into the table. The SAM loans, the shared appreciation, I'm not sure why it isn't. Oh, just because why is it doing that, John?
What is your CLTV? I can't even read that.
Well, it's just at 100%, but it's telling me no.
Yeah, I'd have to look to see what's causing
Yeah,
that.
that's a glitch, I think. But that would be the shared program, which they'll talk more about. I haven't done one yet, but those rates are even lower because they're sharing in appreciation. The second mortgage rate is lower. On the other one, the repayable, it's 9.99, I believe. And I think
Correct.
the SAM is at, is it 7?
7. Yeah,
Yeah.
Sam's at 7.
So only repayable. But yeah, that's just some live examples. So it's really important to look at the rate stack on these when you're talking to your customers as well. I've done several of them, you know, they go well, people like them. I've been able to pull some people out of them a year later and put them in, you know, one new FHA loan or maybe conventional at that time. So definitely something to consider. And it's just a great conversation piece. Like, hey, I know you got all these guys, retail's offering all these DPAs, but they all come with so many strings attached. This one's simple. Yeah, you don't have to be a first-time home buyer. No, there's no income limits. You know, easy peasy. Follow AUS. We're not having these capped DTI requirements. As long as it follows, you know, whatever AUS approves, you're good. So that's my 2 cents. That's why I call it the GOAT. And because John and Kerry are involved, that makes it even more goaty, right? Because you got 2 top-notch guys there, and you know, adding to your arsenal to help you get these things done. So, anyways, I'll let you take it back, John.
Yeah, and
Thanks.
Andy, since you're on, go back to loan and property. So the payment calculator suggestion you gave is kind of in the works. I thought if you toggle on other financing, you know, it is set to no. Did you see on the top second column?
Oh, right here.
No. Second column is calculated. Go on the left.
Yeah.
Yeah, this guy. So if, it should bring in the payment once you have this toggle. So you have to tell the system.
If you have to hit is calculated.
Yeah, you have to say it is calculated. It should, otherwise it's a defect. So
Okay, so it did do it. So I didn't
Yeah, it
know that. So that's cool. So you just click that, it pulls over.
yes.
But what I need
I mean, the good
is-
feedback is now system is seeing subordinate liens, so maybe we should automatically toggle this to yes. That's something we can look.
Yeah, I wouldn't even have that. Well, I mean, I guess you could do yes and then override or something. But I would like a calculator, right?
Yes, no, I think
Like
calculator has been
rate,
requested
term.
numerous times. So a lot of calculators are in the works as we speak.
Yeah,
So,
because then it's in here, it's easy to type in, you know, and then if I update the loan amount, it'll update the payment, right? Like that would be nice. Because to be honest with you, when I have to do this, I just go back to point to do the second mortgage calculation. So
Hey, and we have a calculator on our website, Andy, too, that we can show you
yeah,
how
but
to
I
do.
just want to do it right here. I know
Right,
it's
I know,
possible.
I
I
got
know
you.
I know this is an easy fix. This is cake. They can do this in 3 seconds. So anyways.
And since Andy, we are on, and you know, this is a little digression. Could you explain the process when somebody calls you? Like how do you structure? Like what's your starting point? Are you proactively reaching out to agents? Is that your flow, or you are trying to? You know, how do you find these leads and?
Yeah, so for us, you know, we have like if I get a referral, like hey, they don't have a lot of money to work with or want to explore down payment assistant options. Okay, so you know, I'll send this as an option. I'll send them if they have the down payment as an option, you know, and I'll give them a few different ways to look at how they're going to get their financing. As far as marketing it goes, you know, with our CRM, we'll send out blasts every now and then to our agents or past, you know, just people that never did anything, just whatever. And they'll get a text or email, and we'll talk a little bit about this no income, you know, limits, this and that. So it's a good way to like blast something out to get some conversations with your agents as well. Just do a quick text through your CRM or call them even like, hey, I got this product. We can do 2-1 buy downs on it. Like you can't really do 2-1 buy downs on any DPAs. It's the only one I know of. You know, things of that nature that'll help get you from the door. It's not as painful as the state ones and things of that, you know, so it's good. And then the shared appreciation, I bring it up if they're trying to keep their payment more affordable. You know, like, hey, this is what this looks like, but they do have another one where you can share in your appreciation, and that rate's quite a bit lower. It's way closer to market or even the same. So here's another one you could look at, and then that would be a different conversation because it's a lot of information. So I usually just kind of give a little bit of info on how it works, you know, and explain the non-repayable, repayable, and then, you know, go from there and see. We have a phone call with them, go over the options, see which one fits their needs best. But, you know, talk about how much seller concessions will be needed to do it. Hey, these are more costly because it's a DPA, which is normal. Agents are used to that. So these are just things to like get in their head early on so they understand like costs are higher typically. All those, like, we need concessions, like how much money do you have to work with? You know, I usually try to tell them, you know, depending on the scenario, hey, you still probably might need 1% or so, maybe $2,000, whatever the purchase price range is in, but we'll do our best to keep it as low as possible for you. But yeah, credit score is a big driver on it. So, I mean, there's some pretty good hits when you get under 640, but if you get an AUS approval, you can do them. But again, that's another thing, like, hey, it's going to be a lot more expensive. So we do need a good chunk of concessions here.
You know, that's good knowledge. All right, John, do you want to continue?
Yeah. Well, just well, Andy gave us a real world example already in his pricing engine. So you know, this is just trying to show, hey, if a borrower did a $300,000 purchase price and they had $10,500 was their down payment, this is an example. Hey, this is what their monthly payment would be. You know, $20,000, $2,000, $2,054 on a regular FHA, and then we'll go through. We'll skip past the breakdowns of these categories. Keep going to the end. We'll have this slide available. So this shows here, all right, if you were renting, stayed renting, that's your payment would be on the left. The next one is if you did a regular FHA, about where you would be on the payment wise. If you did our 3.5% repayable. So obviously the DPA options are going to be a little more expensive than doing regular FHA, but that means the borrower had the funds versus a regular FHA did not. So you see where the comparisons are doing the regular, the 3.5, or if you did the 5% repay and the forgive program. So I have a breakdown of that same scenario. So it's going to be a little bit more expensive doing the 5% versus the 3.5, and the forgive is going to be more expensive than doing the repay. As Andy alluded to, you know, these are credit score based. So obviously the pricing is going to vary depending on where your credit score fits. I get asked this question all the time. Hey, which one do you do the most of? And it is, hey, whichever one fits the scores in the first question. And then it's always going to be, do you have seller concessions? Are we going borrower paid? Are we going lender paid? And you know, I do them all. I have seen, we offer lender paid. That doesn't mean everybody goes that route. So I know Andy does borrower paid in a lot of his transactions because he goes and gets 6% sales concessions on his loans. So he's offering the borrower lower interest rates out the gate. So it just really depends on what those options are. So that's just comparison of the shelter costs if we're doing the DPA versus the you know, having their own down payment fund. So it's more, look, guys, you're going to finance the cost of having your down payment, right? But if they don't have the funds, it kind of is what it is. Or the other way to look at it is, what if they have the funds, but what is the thing we do a lot of in this business? We help a borrower purchase a home and we leave them cash poor because we drain the swamp. We empty out their bank account and they have $0 left when their home closes. And then what happens? Now emergencies take place. They're going to have to go and use those 30% interest credit cards to help for rainy day fund. Well, why not use some down payment funds to get them in the door, keep some of their cash in the bank, so that way when they run into those scenarios post-closing, they're not having to resort to those high rate interest credit cards to make that money. So down payment funds are not necessarily just for the people who say, hey, I only got, you know, $2,000 in my name. It could be for people who don't want to use their cash. Or even now with the NAR rules, it could be the bars that we need to pay the buyer's agent. Well, where's that money coming from? Same thing. Utilize the down payment funds to help go into that bucket. So now we got money to go pay that buyer's agent their commission funds. So, all right, we can go move on to the next slide here. All right. So Andy, we've talked about the shared appreciation a couple of times. So a shared appreciation mortgage was our newest entry into our SmartBuy suite. And what we we said, look, what if we offered a program that allowed the borrower to get down payment funds? So this mimics our repay program. So you're going to still have a first mortgage and a second mortgage with a payment, but the rates they're going to get will be lower when compared to our normal down payment assistance program. So it could get the borrower into the home at lower interest rates, which means lower monthly payments. But the trade-off is they're going to have to forfeit some equity in their property in the future in order for them to get that real life savings today. We have seen this program be utilized for multiple ways. One, it's for those fence sitters, as I like to call them. What if we have a customer says, hey, I want to buy a house. I want to get in the door, but I don't want my payment to be more than X, right? Hey, they could afford a much higher monthly payment, but they don't want to pay a payment higher than this. And so you could give them as an option to say, okay, guys, well, here's an option for you that we can give you a payment lower than the normal DPA. It'll give you real life savings in monthly payment versus if you pay the standard, program. The other option is, what if these lower rates is the only way to get someone out of being a permanent renter? As we circle back to when we started this conversation, our goal is to help generate as many people into homes as we can. Get them out from being a renter, which means get them on the opportunity path of earning wealth and home ownership. So if maybe the only option to get them into the house is by using the shared appreciation option because of the lower interest rates, the lower payments, at least it gets them out of being a renter. It gets them on the path of home ownership. Because if they rent currently, how much equity you're getting? 0% of your payment every month is going towards anything you're getting back out of it. So that was sort of the mindset of the two ways to look at how to utilize the shared appreciation program.
What's you gonna call this one, man? Uncle Sam or what?
Yeah, the Uncle Sam program. There you go.
And John, you were explaining earlier. So after 5 years, like 40% is what becomes the.
Yeah, in a nutshell, the way the program works is there is a already agreed to schedule of the equity share that the borrower is going to agree to at the beginning. And it says for the first 3 years, it's 100% of their equity. Year 4, it's 60%. And then year 5, it's 40. Okay. And what we'll do in the 5th year is we're going to order an AVM on their property, determine how much is appreciated in value. Whatever that dollar amount ends up being, we'll take 40% of that. And because we're servicing both the first and the second mortgage, as a benefit to the customer to keep them from sending money out of their pocket, we'll just take that equity piece and add it to their current second mortgage balance at that time and recast the payment. So worst case scenario, their second mortgage payment would go up in 5 years. But there's no guarantee of what we're going to be at in an equity position in 5 years. We're gambling that that there's going to be some appreciation. I'm sure the borrower was gambling that there's not going to be any appreciation. I mean, it's a gamble on both directions. But what we've seen since we did this program, guys, we didn't create a shared equity piece by no means. There are second lien holder companies out there offering home equity lines of credit. You give up equity to get money and no payments made, right? State housing programs. California is big on shared appreciation in their market, but there's some other state housing programs that are coming out first of the year also utilizing shared appreciation because they think that's the path to affordability. Because borrowers, again, because where rates have went, where home prices have went, some other state bond entities are saying, hey, maybe this is another avenue to help borrowers get into the homes now for payment purposes. So is it a program for everyone? Absolutely not. But it's a great option to consider to give your borrower another option to look at. So I think we have a breakdown of where we so the shared appreciation, the second mortgage is at 7% versus 9.99. compared to my normal repay. And then that first mortgage will be lower. The only other carve out is we generally don't want to do this loan in any area that's in a flood zone. Manufactured homes are not eligible for the shared appreciation. They're only on our normal products. But we will do, single family homes or townhomes.
Hey, John, you guys do single wides too, right?
No, we only do double
Just the
wides.
double?
But we also will do 2-1 buy downs and permanent buy downs on this program as well. So same thing. You can have the buy down options on the shared appreciation program to make it work. So all right.
So our first liens will be in what was in 2020, like 3-4%. Is that correct? They're already lower rates, right? So
The first mortgage, you have options to get into the low fives.
the five.
Prior to 30 days ago, we were in the low fours. Obviously, markets moved, so we're in the low fives at this point. But I have locked some loans with people in the low fours on doing the shared appreciation.
Right.
We took one of our other clients took this product and went and approached home builders. All right. And said, hey, Mr. Home Builder, I know you have an in-house lender, and we all brokers, we've all tried to get into that builder business. So they always put up that wall. Oh, I got my in-house lender already, pound sand. Well, they said, okay, but I know you're denying some borrowers because your in-house lender's DPA program rates are too high. How about I have an option that provides down payment assistance at lower interest rates, but I need you to give me the same concessions you give your in-house lender. So the builder has said, okay, fine. And so now they get 6% seller concessions. They're using that concessions to buy down this rate and giving these borrowers a much lower interest rate to get them in the door. And the borrowers are happy because they didn't have to pay for that. The money came from the builder. So it's been a win-win for everybody. And they started out with a local builder in their local market, but then some of the larger nationwide builders heard about it, and now they've gotten contracts from some of those other builders in the same market because they've heard about the success they were doing with this one individual builder. So it's making sure your agents, people you're talking to, know what additional tools you have available and products to sell to help get people in the home. And this is just another option of that. And I think, Haresh, we have the slide that shows where the payment was at the end. Keep going. So now, again, before we talked about our DPA options. So now if you look, the shared appreciation is the one on the far right-hand side. And it is actually either equal to or maybe slightly lower in total monthly payment than if this borrower did a regular FHA loan today. But instead they got a 96.5% first mortgage. They got a 3.5% second. So they got 100% financing and at a lower interest rate or lower total monthly payment. Maybe they ain't even doing a regular FHA loan right now. So there is some pricing advantages within that loan when you look at them. Is this replacing our normal down payment assistance product offering? By no means, no. It's just another option we have available to our clients to give borrowers more options available to them to get them in the house.
I think too, like, somebody doesn't qualify or doesn't like the payment on the higher rate stuff. You know what I mean? Like maybe that's another thing too. Like, well, we can get you higher. Like if it's not a high enough price, we can go into this program. We can get you higher on that price.
Right.
Or hey, we can't get it to approve at this one, but we can do this one.
There's a lot of options to utilize that product. I've had people say they just do a side-by-side comparison, offer their borrower two options. Hey, here's a regular repay. Here's shared appreciation. Here's the payment savings. In that example, I think it was a $320 a month payment savings difference. Well, if they keep that loan for 5 years, multiply 60 payments by $320. You're like $19,200 as to the savings that borrower saved during that 5-year time period. So even if that home appreciated 50 grand, 40% that's 20,000. They about broke even during that 5-year time period because they had real live monthly payment savings compared to the regular down payment assistance option that they could have had. So, but guys, that's the the 10,000-foot view, as I like to say, on our normal DPA, on our shared appreciation products. Again, as a recap, we can do these as broker or non-del, no income limits, no first-time home buyer restrictions. The DPA funds can be used for down payment, closing costs, a mixture of both. We got forgivable and repayable options. We have the shared appreciation option. We do now also offer it on a 203K. So not only can you help a borrower buy that fixer upper, they can get down payment assistance funds to help them on that fixer upper property as well. You've got our contact information here on the bottom right-hand corner if you want to reach out to Kerry or myself. And I guess we got some time to answer some of these questions that are down here.
Oh, there's a ton of them. Yeah.
So I have a question. This is more of a curiosity. The shared appreciation is truly unique. Again, we work with many lender partners. We have not seen anyone offering such a model where you can get someone in the home and then they kind of share the appreciation. How does practically it work? Let's say there are down payment funds, or if 5 years is a long time, I do some renovation. Do they go out, or how is appreciation calculated? Anything, John?
So if they're doing renovation, of course, that's not going to, they're not losing money that they put into the house to improve the value of the home. So I think the verbiage reads that obviously since we service these loans, they're in communication with us if they plan on doing renovations to the property. So we're aware that, hey, they've spent X amount of dollars doing improvements to the home. So when that math calculation is done in 5 years, that number is accounted for, right? And any monies they put into the loan at closing obviously are not counted in that formula as well. So it's basically only monies that they would have paid beyond the closing table or any renovations they've done to the property since then on that equity piece. That answer your
At the
question?
end of 5 years, we'll send out an appraiser, or the borrower can do a BPO. It's really up to them to determine the value of the property at the end of the 5 years. They got a couple choices there.
Hey, let's go through. There's a ton of questions in here, guys. So they wanted to go over the subordination section and payment again. I think it was, maybe I already did that one. It's probably in the recording. The recording, people are asking if they're going to get a copy of this recording and slides. That's a yes, right?
Yes, it'll
Okay,
be on
so
our
it'll
YouTube
be in
channel.
there, and that'll go over the how to do the subordination section. Somebody says, is there a restriction? There's really no restrictions on it as far as being a first-time home buyer, income limits. Somebody asked about doing 3 or 4 unit. No, I know
Yeah,
it's
you can do a
capped at
2-unit
duplex,
property,
right?
right?
Huh?
You can do a 2-unit property, but not
Yeah,
3
up
to
to
4
2.
unit.
Yeah. There's somebody asked, there's a prepay on the SAM loan. So SAM loan, there's always you have to pay back the whatever the shared appreciation calculation is, right?
Right.
Yeah. And then that same thing goes for the streamline. You really can't streamline these because
There's a
you have to
second
pay off the
mortgage.
first
Right.
and second.
Yeah.
And to use the current appraised value on FHA, you need to own it a year. So basically you need to wait the 12 months to do anything with that. Does underwriting consider borrowers with too much in assets? That I don't think they care how much assets they have, as
No,
long as they
yeah.
qualify.
We don't care how many assets you have. We don't care what your income limit is. Assets are not something that are restricted. The buy down is seller paid on on this particular program.
Yeah.
And again, why would somebody use a DPA that has a higher rate and a payback? Well, because they don't have the funds available right now to buy that home, and they can't get funds or whatever, and the only option they have is to go with a down payment assistance. So
yeah, and I think there's another one. How much is the owner seller? We'll have to get back on the share. I mean, once the buyer owns it, they'll have that calculation. It was what, 40%?
At year 5, it's 40. Year 4, it's 60%, and then it's 100% during the first 3 years.
Yeah, so any appreciation goes to you guys under 3 years and under, right?
Right.
What's year 4 then? Year 4 and 5 is the 40?
Year 4, it's 60%.
60 and then 40 year
and then
5.
40. It caps out at 40.
Somebody asked if it's similar to the G.O.A.T program. I'd say it's similar, maybe how it works, but I think G.O.A.T pricing is way higher, worse than something like this. Probably a lot more extensive.
Pricing is worse. The Chinoa repayable option, the second mortgage is on a 10-year amortization. Ours is on a 30-year amortization. So that monthly payment for DTI purposes is a lot lower. You've got, somebody asked about TPS on the 203K. Again, we follow all the FHA's guidelines for 203K loans, for our down payment assistance loans. So I have done work visa types by everyone known to mankind, I think, on the down payment assistance loans. So I don't restrict them to only certain ones, or even doing a the 203K option with that would be the similar.
What credit scores needed? 580 with AUS?
No.
600?
So for the normal DPA, we're at 620 on the forgive and 660 on the repay. The shared appreciation, in theory, has no score requirements, but the pricing hits that you're going to see, you're not really going to price one out below a 600 credit score on the shared appreciation.
Yeah.
So wait, what's the minimum FICO on the others? Because I got pricing.
620.
I got pricing at 600.
On the regular, oh, we'll have to take that one offline there, Andy. You forgot why that's pricing.
Yeah,
out at
I mean, it
600.
was that one I pulled up was the 600 and
Yeah.
the repayable or not repayable. The other one came up,
The
forgivable.
forgive came up. All right.
What is MCC, mortgage credit certificate?
Yeah, we can't use
Yeah,
MCCs on the
Don't
DPA.
let it.
Yeah, does the
One
DPA
question
work?
I've answered a lot is how to calculate the payment on the repayable. And that's, we're at 9.99 on a 30 due in 10. That's how you calculate the payment on this second lien
Yeah, you'll
repayment.
have to until Arrive gets it in there for us. We'll have to do it somewhere else, Google or something.
One of the questions was about a lot of people don't want to do DPA loans because they feel there's a lot of hoops to jump through, a lot of work, blah, blah, blah. And that's why I alluded to earlier. This is really no different than doing a regular FHA loan, guys. There's not a lot of hoop jumping to go through to get these transactions, done. That's Andy can
No.
attest to that. But it's like your contract time is your normal time you get on an FHA contract. I have closed a DPA loan as soon as 7 business days, which is
Yeah,
legally
they go fast. It's like doesn't feel hard. It doesn't feel different.
and that's the legally limit you can do a loan with TRID as far as 7 business days. So I have done one that quick, when we've gotten an appraisal transferred over or whatever. But yeah, so there's lots of options. Can do that.
and then does the DPA work with the manual underwrite? Do you even allow them?
Yeah, forgive
660?
program with 620. We can do a manual as long as we follow FHA's manual guidelines.
So this one guy, he said he had approved eligible or chapter 13 discharge less than 2 years, but it was approved eligible, but that should be fine.
That's a manual downgrade, but we can do it.
Yeah, it is a manual downgrade. Yeah.
Yeah.
So let's, where can we find resources for reference? So your website, the slides will go out. You'll have all your contact info on there.
Yeah.
How to find things. Can we use per diem income with FHA? Well, they follow FHA guidelines. So if it meets the guidelines for per diem income, I believe you could use it. Our buy downs are paid by seller always, right? So
on this program, yeah.
Yeah, seller. So even if you have if you have concessions from the seller, then you could use them for the buy down, and then the rest of the closing costs you could use the assistance if you were short, but you need enough from the seller to cover the temporary rate buy down. Why would someone use a DPA that has a higher rate and payback? Well, there's a million reasons why, right? So it works well for some people, not for everyone. So that's just the name of the game. Have a client would like to apply to purchase a house with some acreage in Wilder, Texas.
I think Andy froze.
Yeah, I don't think we don't.
Go ahead.
No, again, we follow FHA guidelines, so I don't have an acreage restriction on it. So there's not an issue with acreage doing this. So
did we address comp at all? I know that you guys mentioned you allow, a bar.
I'm pretty sure whatever the FHA level acreage is.
Yeah, I mean, we didn't address comp specifically.
I think up to 275.
Yeah, up to 275.
You guys have a max?
No, 275 is the max. So.
Yeah. Yeah, the
None do,
203K
we
is their
don't.
limit. Well, it's the limited, what do you call that one? The streamline, so it's up to 35,000, right?
Limited as of November 1, I think it just increased. I think it's at 50 or 75,000 now. The limit amount just went up.
Oh, cool.
Yeah, so it's opened that up for more people on the 203K for more than just the 35,000 now. So
All right. Well, I think that's all the questions
Yeah.
that we could discuss anyway. Anybody have any other questions?
And Amy or Harish, I guess you're letting people know when these slide deck will be available, when the information will be where they can, if you want to can you put our slide back up again with our contact information, Harish, so people can take a screenshot of that real quick?
Yep, I'll do that. They're also asking for your number, John, if you're comfortable sharing that.
Sure. Ready? Everybody get a pen. So 704-960-9765.
So here is their contact information, and you got the number from John, so please do bug him. He loves people calling him or brokers calling him. So
Yeah, I don't think anyone would be upset trying these guys out on these. It's a refreshing change of pace for a DPA loan process and flow compared to most of the ones we've all worked with. So definitely give it a run. Of course, depending on what your client's needs are, it may not be for everyone. So if you got a good fit for it, definitely give them a shot.
all right, this was a very educational webinar. So again, thank you, John and Kerry, for joining. And thank you, Andy, for showing live how you can structure them in ARIVE. We have your feedback. But again, thank you, everyone. Hopefully, our audience got something out of this. Within a few days, it'll be on our YouTube channel, and we'll make announcements on our Facebook group when this is posted. But I want to thank everyone again for their time.
Thank you.
Thank
you.
Appreciate it.
Close.
See you
Bye.
guys.